directives that'll make it maybe a little more clear. And I'll also give you some links to several websites and maybe some forums where people are talking about this openly. I think you'll find that in the industry there's a lot of openness with people who are connecting, and there really is a genuine desire to kind of dial in and make sure that people are compliant and also meeting the best the needs of their employees and their companies at the same time. So as Crystal mentioned, I am a headhunter / recruiter. I've owned my own firm for several years now, and I've helped many mortgage industry leaders to find homes with outstanding companies, and I really, really enjoy making a difference. You know, I think that this these compensation regulations are going to really give some companies who do this right an advantage over the competition, and I really see it as an opportunity, if you haven't already set your compensation plan, to evaluate that and to make it as attractive as possible to win over the best talent. So Coester Appraisal had approached me and knew that I was out there talking to individuals. I have had a lot of conversations with loan officers and managers, area managers around the country about compensation changes, and it is becoming a hot topic. I can tell you that on a daily basis when I'm talking to potential recruits, it's coming up in conversation with them. I can also tell you at some level that I have not seen in stone very many compensation plans. So I'm going to give you some ideas about what companies are talking about, but most companies have like a preferred plan and then many contingency plans that they're going to base on kind of what they see other people doing over the next couple of months. I also wanted to emphasize here that I'm not a lawyer, so I wouldn't take my word as the final word as you set out your compensation plans. I would take this information just to help improve your knowledge of what's going on and maybe bring you a little more in the know if you haven't done some research already. But it's probably smartest to sit down with your lawyer and have a long conversation about how this will actually end up. There's a lot of details that we won't go into. I think the reform is very long. There's no way to do that in a short amount of time to cover every little detail. But let's go ahead and get started here. This is who I am. I live in Idaho, so any of you who like world-class skiing, we'd love to have you anytime. It's a great, pleasant state where people are friendly and you don't have to worry about locking your front door because, you know, we really don't have all of the crime and all of the kind of things that come along with the big cities. So I really enjoy it here. I put my phone number here. If you have any questions that you'd like to talk with me after the presentation, you're welcome to call me directly. So this is the way I feel. I wish I could hear some laughs, but I hear from a lot of people in the industry that they're feeling kind of tired. You know, 3 years ago, the industry was just hopping along. It was great. Lots of business was getting done. There was not very much regulation. And then we had this mortgage crash. And so it seems like we've been staying up day and night just trying to keep up with all of the changes that have been happening. Last year we had some manna from heaven. This manna from heaven came in the form of lower rates, and it seemed like business was really doing great from a loan perspective. Maybe not as much on the purchase, which I'm sure our appraisers are going to want, but I hear this a lot, that people are tired. I hear people sometimes saying, you know, I'm not sure if I want to stay in the industry, but it's the only thing I know. I get it. I think we all get it. This new reform just adds a whole new element, But I think that things are looking up. We've definitely made some progress in the last year. People tell me that they did a lot of business better than in 2009. So I think we have every reason to believe that 2011 will be even better. As I look through a lot of the blogs and a lot of the training online, I found a couple of articles and a couple of references that I'd like to share with you. And again, at the end of the presentation, you know, we'll go through this pretty quick. If you want to send me an email, I have my email listed at the end. You're welcome to send me an email, and I'll send you this entire presentation for your reference. I wouldn't stay too busy taking notes because a lot of this stuff I put in verbatim. So I'm just going to go ahead and read this through with you. For those audio learners, you'll appreciate that. For those visuals, you can go ahead and just read along with me. But this is an article written by Anna Avidable, and it was published, I believe, in November in the Scotsman Guide. She did an outstanding job of really summarizing the main points. The Federal Reserve Board's final rule on loan originator compensation takes effect April 1, 2011. That date marks the end of an era in how mortgage brokers, mortgage company employees, and even loan officers within banks are paid. The final rule announced this past August 16th prohibits paying mortgage brokers and other loan originators based on the interest rate paid by borrowers or on any other term or conditions of the loan other than the credit extended. As a result, the rule prohibits yield spread premiums that is based on the interest rate and common means of getting, let's see here, and interest rate overages paid to loan originators. For many brokers and other loan originators, YSP has become a common means of getting paid. Because the new rule applies to loan originators defined as people who arrange consumer credit for compensation, it will cover mortgage brokers, certain employees of mortgage companies, and financial institutions and lenders themselves if they are extending a loan that is funded by another creditor. The rule, however, only applies to close-ended consumer credit secured by a dwelling. Consequently, commercial loans aren't covered even when they are secured by someone's home. Home equity lines of credit and consumer loans not secured by a dwelling also aren't covered by the rule, although the Federal Reserve plans to consider whether they should be as it issues more regulatory requirements in the future. Compensation limits. The final rule contains two primary provisions, limits on how compensation is calculated and paid, and a prohibition on steering. The compensation limits that the loan originator, such as a mortgage broker, cannot be paid based on the terms and conditions of the loan. As a result, mortgage broker compensation can't be calculated based on interest rate, annual percentage rate, loan-to-value ratio, or the existence of prepayment penalties on the loan. Let's see here. To prevent evasion, the Federal Reserve also prohibits compensation based on a proxy for the loan's terms and conditions, such as borrower credit scores, debt-to-income ratios, or credit risk. A mortgage broker may, however, be compensated based on factors that don't represent terms or conditions of a loan, such as, so these are the things that it can be based on: the total number of loans from the broker that were originated, the total amount of credit that was extended from the broker's loans, the performance of the broker's loans in the long run, the number of actual hours work performed by the broker paid at an hourly rate, legitimate business expenses such as overhead, whether the borrower is a new or existing customer, the percentage of applications submitted by the broker that result in closed loans, and the quality of the broker's loan files, such as their accuracy and completeness. Brokers also can receive a payment fixed in advance, such as a per-loan fee. This can be a flat fee for all loans arranged, or it can differ for specific loan tranches. For example, brokers could be paid $1,000 for each of the first 1,000 loans they arrange, and a different amount for each loan after that. Another compensation option includes paying brokers as a percentage of each loan amount. Specific requirements apply if this option is used, however. First, the percentage must be fixed and can't vary with different loan amounts. Second, the compensation arrangement can include minimum and maximum amounts of compensation, but these limits must not vary for different transactions. For example, brokers can be paid 1% of the loan amount for all loans originated and can have a minimum and maximum fee in their agreement with the lender. The broker cannot, however, be paid different percentages for different loan scenarios, such as 2% for loans to $300,000 and 3% for loans more than $300,000. Another individual summarized the rules as saying, brokers will only be able to receive compensation from either the borrower, lender, but not both. That's pretty set in stone. Everybody, I'm sure, has taken this away, had that takeaway. YSP, no matter how it is categorized, is compensation paid by the lender. Creditors will still be able to charge borrowers origination points and compensate their originators from both the origination points charged and YSP collected. When the lender is compensating the broker, the compensation must be the same for every file, subject to minimum and maximum charges. Originators that work for lenders will have to set their compensation for every file. No more overages for retail loan officers. If a borrower is paying the broker's compensation, the broker can negotiate compensation directly with the borrower. However, no other party may compensate the broker. If lenders are unable to provide net pricing, wherein they charge the borrower directly for the origination shortage that YSP is sufficient to cover, the broker will not be able to offer mixed cost options. So we've got a lot to think about here. There's a lot of information contained in this new regulation. Okay, so I wanted a little distractor here. We just covered a lot of information here in these two articles. And so I wanted to see, Crystal, maybe you could help me if we've got dog or cat people out there. Is there an easy way to have people poll? I'm just interested in my audience.
Sure. Let me go ahead and see if I can pull up a survey for you. Let me go ahead and take a second to do that. Just bear with me. Okay. All right. All right. Let's go ahead and see if we can pull that up. All right, let's see if I can pull that up here. Bear with me for one moment. Oh, a lot of people are answering dog already. Haven't even pulled that up yet, but let's see. Yeah, if you all would be interested in going ahead and messaging your answers. We got a lot of dog people here, Larry. We have one neither. Yep, Larry, we're looking at dog here.
All right, so the dogs win.
Oh, Larry, you sound far away. Could you come closer or turn up your headset volume for us?
Is that a little better?
Nope, still can't hear you.
You can't hear me?
No, you sound very far away.
Did I sound fine just a minute ago?
Yeah, I can't hear you.
Did I sound fine just a minute ago?
Yeah, you sounded fine just a minute ago. I don't know what happened.
I wonder if when you mute back out, it will go back.
Let's see. I got you turned all the way up here on my headset, but you still sound like you're in a tunnel.
Does everybody else get the exact same amount of voice?
Yeah, I can barely hear you. Can anyone else? Yeah, we have some no audios here. Yeah, no one can hear you, Larry.
Should I change the audio mode to telephone?
Yeah. Okay, everyone, sorry about that. We're going to have Larry call back in and rejoin the webinar. Sorry for the inconvenience of you all not being able to hear him. We're going to have him dial in again, and hopefully that'll remedy the issue. So please stand by just one moment. Thank you so much.
Hello? Crystal, can you hear me?
Yes, there you go. That's much, much better.
Okay. So I apologize. So was the first part of that, were people able to hear it?
Yes, there were a couple of people who said that you were fading in and out, but I was hearing it clearly. But it seems like we're getting feedback now that they can hear you better. So hopefully
great.
It'll stay the same.
I apologize. I'm glad that I chose to put in the full text of what we were covering.
Yeah, definitely. So just to let everyone know, we are currently recording this, so this will be available 48 hours from today, both the webinar presentation as well as the audio. So no worries. Larry, you can just pick up where you left off. We got about 90% of people saying that they're dog people, so you can go ahead and proceed from there.
All right. Well, happy to know that people go with the smarter of the two animals. I guess we'd have to go to yeah, that's great. So I'm not going to start a fight here. I just thought that would be a fun distraction after we covered such heavy material. Again, I'm also happy if you send me an email. My email's at the end of this to send you this entire presentation. I thought it would be helpful to give you the actual links to the text of the compensation change rules. Now, we're really talking about, and I know at least one person had made some comments about this, that we're really not only talking about Dodd-Frank. Dodd-Frank kind of set things in motion, but the Federal Reserve was given authority and really carried on the regulation in Regulation Z of the Truth in Lending Act, which is also TILA. I'm thinking that that's how they say that, the TILA. And I put these links here for your reference. I would also encourage individuals who have a lot of questions after this to try maybe going to Yahoo Groups or join me on LinkedIn. And you can join groups that are out there right now talking about compensation. One of the advantages of doing that is you could put some specific scenarios up and really have hundreds of people helping you on that. So these are some helpful links. All right. Wells Fargo released a letter in regards to its wholesale lending. I thought this would be valuable to go over. The summary, Wells Fargo wholesale lending is committed to keeping you informed of regulatory changes ahead. We know that you have heard different and conflicting information about financial reform and subsequent rules issued by the Federal Reserve. As an industry leader, you can rely on Wells Fargo to provide you with timely information about these important changes that affect us all. Effective April 1st, 2011, the Federal Reserve is implementing Regulation Z compensation and anti-steering changes under the Truth in Lending Act. Below you will find the details of these upcoming changes. Who the changes affect. The new federal rules affect all mortgage loan originators, not just mortgage brokers. After hearing about the new rules, you may have become concerned about competing in the marketplace, but know that everyone who originates mortgages will have to comply, including the banks. mortgage brokers, correspondent lenders, direct lenders, and their agents. Compensation overview. In part, the rules prohibit a loan officer from increasing their compensation by raising the consumer's interest rate. The rules allow a loan originator to receive payment from the customer, the consumer, or the lender, but not both. Receive compensation based on a percentage of the principal amount. Compensation details. We want you to continue to be successful. To successfully operate your business, you will have to make some changes, but we are confident that the compensation models will allow you to remain competitive and to sustain your business model. You still be able to offer a variety of rates and products to meet your borrower's needs while remaining competitive. With Wells Fargo, you and your borrowers will have the choice to select either a consumer-paid or a lender-paid model with each loan, which will provide you options to fit a variety of business models. Below is an overview of 2 models. You'll hear more in coming weeks about the specifics. Note, while reviewing each model, note the different impacts between broker and loan officer. Okay, so this first one is the consumer paid. The loan originator will negotiate directly with the consumer regarding compensation. The broker owner will have to establish compensation agreements for their loan officers that cannot vary based on prohibited loan terms and conditions or proxy for those loan terms and conditions. While compensation to the broker owner can vary from transaction to transaction, the compensation from the broker owner to the loan officer cannot be based on prohibited terms or conditions. There will be no minimums. However, a compensation maximum amount will be set to address Wells Fargo's fair and responsible lending principles. If a party other than the consumer pays the compensation, they must pay compensation in full, not just a portion. Third-party costs can be financed through the loan principal or interest rate. If borrower selects premium pricing or SMC, the premium pricing can be used to cover the third-party costs. Total premium pricing cannot exceed the total of the third-party costs. Premium pricing cannot be used to compensate the broker owner. Compensation can't be paid through rate, but can be financed through the loan principal or paid in cash at closing by the consumer. Broker owner compensation limitations based on the loan terms and conditions will not apply when the consumer paid model is used. However, loan officer compensation cannot vary based on prohibited terms and conditions regardless if the consumer or lender paid model is used. On the lender paid side, compensation is paid to the broker owner. Broker compensation is paid as a percentage of the principal amount with minimum and maximum dollar thresholds. The broker owner will have to establish compensation agreements for their loan officers that cannot vary based on prohibited loan terms and conditions or proxy for those loans terms and conditions. Payments based on prohibited loan terms and conditions or a proxy for those loan terms and conditions are not allowed under the lender paid model. Third-party costs can't be paid by the broker. The broker owner will have to pay for these costs by paying cash at closing or by financing them through the loan principal or interest rate. If the borrower selects premium pricing or SMC, the premium pricing may be used to cover their third-party costs. Total premium pricing cannot exceed the total of the third-party cost. Compensation may vary by geography to take into account differences in the cost of loan origination, such as rent and other overhead expenses. And then it goes on to explain anti-steering and anti-steering details. We'll go ahead and skip that for now. SunTrust Mortgage also came out and gave their insight into how they're going to be dealing with brokers, and they gave these 2 scenarios. The first one is borrower paid is an option where origination and processing fees will be paid directly by the borrower, and STMP partners will validate to ensure the amounts charged do not exceed the 3.5% broker compensation limits. After you select a product, STMP partners will calculate the rate price options for that product. Negative discount points may cover all valid third-party closing costs, excluding the broker origination and processing fees. Broker compensation will not be added in the pricing. When borrower paid compensation is selected, you may not receive compensation directly or indirectly from any other entity in the transaction. Number 2, the lender paid is based on pricing negotiated between the broker and the lender. The negotiated payment will be used for all loans sent to STM and will be set up prior to registering loans. When the loan is registered using the lender paid option, the negotiated fees will be added to the prices displayed for the product selected. The system will test to ensure compensation meets both the price caps and compensation floor. When lender paid compensation is selected, you may not receive compensation or fees from the borrower. At this time, we anticipate your negotiated compensation to be renewed or restructured quarterly. So these are 2 ideas coming from big banks, hoping that that's helpful. They have posted these online, and I know there's a lot of discussion around these as well. All right, so now we're going to get to some fun stuff. I'm going to give you some insight on what I'm hearing out in the field when I'm talking with mortgage managers and loan officers, what they're hearing. And after we cover these, then we'll go ahead and open it up for some discussion. I want to say that you know, some of you may have insights that I'm not aware of, and so I'd encourage participation during that part of the Q&A. So one broker that I spoke with says that they will be paying a flat fee in terms of basis points. They will have a tiered comp plan that encourages volume with additional incentives for loan quality like pull-through, underwriting touches, and GFE TIL accuracy. So this is an example of what one person said. Getting into the exact details of how they're going to handle that, I haven't gotten that level of detail, but it helps to know that their basis points will be something that could vary, and that's a good way to reward your loan officers for volume by giving them that type of a basis points, which as a loan increases, so does their compensation. Many companies have run various scenarios but are taking a wait-and-see approach. They will be watching the big banks and have committed to create competitive comp plans based on what they do. This is probably the most common response that I get as a recruiter in the field. A lot of companies are not moving. They may have a plan or 2 that they are expecting they will roll out, but kind of the target and kind of the model are going to be the big banks to a lot of the mortgage banks and broker shops. One mortgage bank said that they will adjust comp based on agreed upon points charged on a monthly basis. They are waiting for clarification to see if points charged can be charged on a quarterly, monthly, or even a daily basis. And so this is interesting that some companies have said that they're going to have a loan officer compensation based on how many points that they'll build into a loan, but they have to have that set. And they may have to stick with it for an entire month or a quarter. Some companies have said we'll give our loan officers the ability to really change their comp plan on a daily basis. I don't know what the real answer is. Most of the chatter that I hear is that monthly is probably the least time frame for doing that. Another mortgage bank broker says that they will pay on a tiered plan and will also add a profit-sharing element to employees on a quarterly and or annual basis. And I'm not really sure if this will work, but that's what they're talking about. They basically said that we're going to have compensation as usual, but since overages and YSP are going to be kind of taken out of the factor, at least there's not as much lenience on those things, that they were going to compensate based on probably an annual basis, have some sort of profit sharing. Again, this is what they say. I'm not so sure that that really fits in with the rules that have been set as I read them. One company said that they will pay a base salary on past performance adjusted quarterly. In this example, they will calculate the total income made by the loan officer in 2010 and set their salaries at a similar level. The expectation is that performance will be similar. If performance goes up or down, salary will be adjusted according to the previous quarter's performance. So in this model, they're basically going to pay the loan officer on an hourly or a salary basis based on last year's performance, and they will adjust it quarterly based on how the loan officer continues to perform. Another company says that it will adjust BIPs paid out for all loan volume on a monthly basis. If the loan officer does not stay within acceptable standards, then the BIPs would be less. If the loan officer meets the standards, then they would be raised the following month. So again, this is kind of paying them out on a BIPs plan, and if they feel like the loan officer is not meeting expectations, then they'll lower the BIPs and vice versa. One individual said that their company has already instituted a new comp plan that has eliminated overages and higher premiums for government and CRA loans. Loan officers are paid an hourly rate versus per loan. Overtime is offered to loan officers that close more loans. The more they produce, the more overtime they get paid. If a loan officer is producing 2 to 5 units a month, he or she does not get overtime. Originate 15 to 25 units per month, and you get paid plenty of overtime. Doesn't mean you have to work the overtime, but you can claim it on the timesheet. Overtime pay could be $100 to $150 an hour. Okay, I'm not telling you guys to do stuff like this. In fact, that's probably going to meet some challenges. It doesn't sound really above board to me, but I'm shooting straight with what I'm hearing on the street. Some companies say that they will change absolutely nothing. Again, that's one I don't know how things are going to be regulated, exactly how fast that's going to roll out, but that's what some companies are telling me, and some believe that the decision will be delayed and will not happen into April. As I read a lot of opinions and then as I talk to other people, the chances of that seem highly unlikely. I think April 1st is going to come, and we are going to be held to a new standard come April 1st. I don't think it's going to be delayed. All right, so I'll just leave this slide up for those of you who would like to send me an email. I'll be happy to send you the text along with the links that I refer to. And Crystal, I'm happy to open it up for questions and answers.
Okay, great. Thank you so much, Larry. I just want to thank all of our attendees for bearing with us through some of these audio issues. However, if any of you are interested in speaking with Larry during our question and answer portion, which will be starting in the next couple of seconds, please feel free to chat me so that I can make sure to take you off of listen-only mode and therefore allow you to speak directly to Larry. Larry, in the meantime, while I wait for some feedback, I did have a couple of questions come in during the presentation, so I'll just start with those until I get some, chats stating that they would like to speak in. So we'll go ahead and start with a couple of questions from our attendees. The first question that came in was from Kathy here, and she asks, HVCC impacted conventional appraisals, but Dodd-Frank impacts FHA and conventional. She just wanted to clarify whether or not that was correct. Could you provide more insight for her for that?
Is the question specifically, does it apply equally to conventional and FHA loans?
Yes, the Dodd-Frank financial reform, does that apply to both FHA and conventional?
My understanding of the comp plan, the new comp changes, not specifically just Dodd-Frank, but all of them in synergy together because they all roll together, is that every loan, as we mentioned, that is secured by a dwelling, it applies the same.
Okay, okay, great. And another question here from Joseph states, if a loan officer cannot be compensated for a higher price loan, how could you pay them profit sharing? I don't quite know if you have an answer to this, but any feedback on this question you can go ahead and provide to them. That'd be great.
You know, I think that the intention is clear that they don't want loan officers to be paid based on making loans way more profitable. I can tell you that things have not changed behind the scenes. Companies are still interested in making money, and in fact, in some of the compensation agreements that I mentioned from companies, there is, in some cases, going to be an agreement. Hey, you're going to receive this compensation, but you have to agree to this. Like you're going to have 2 points, and in fact your price sheet may reflect that 2 points. But how people will do profit sharing and kind of sneak through the cracks, I don't know. That was one of the iffy plans that I wasn't sure. Now, there is a stipulation in the text of these requirements that loan officers can be compensated based on the long-term performance of the loan. But again, this is one that a lot of people out there are saying, yeah, right, like we're going to have a loan officer who's going to be following this loan for the next 2 years. That deferred compensation probably isn't going to work out. So I wouldn't hang my hat on it. It's something worth looking into, but I didn't see that that was a normal way that companies were going to be handling this. More likely that they would be doing the bonuses based on things like pull-through and the quality of their loans, some of those that were listed in the presentation.
Okay, okay, great. And Gina would like to know how the seller paid costs would be considered in this equation.
Can you clarify that? If the seller is paying the seller paid costs, can you clarify that for me?
Gina, if you have any, more details involving your question, please feel free to chat that to me. We'll go ahead and get back to that one because that was simply just a one-sentence question that Gina asked. So once Gina gives me feedback on that, we'll go ahead and continue. Stephen asks, he states that he works for a credit union and he's paid on the points that he charges, which is a flat 1%. He states that he's paid on a tier basis, and he just wants to know if this structure is already in line with the reform bill.
You can be paid either on the yield spread or from the, it's either going to be built into the loan based on what you're charging. You can't be paid on the front and the back end anymore. So if you're talking about front end and back end, then the answer is no, you get one or the other. And I think that that's one thing that's been made very clear. There is also, you either get paid from the borrower. Now the borrower, it seems like this is probably going to be the hardest for loan officers to deal with, and I don't know how the banks are going to deal with this. It's probably going to be something that the brokers are going to pursue, where either built into the loan or paid in cash at closing, the borrower is going to pay it directly. And it doesn't seem like there's quite as much regulation. There just can't be any back-end deals happening. You can't make anything else off of the loan. I hope that helps.
Okay, great. And Jeffrey just wants to see if you could elaborate on your point earlier in the presentation where you stated that creditors or lenders will still be able to charge points and compensate their originators based upon points and the YSP.
Can you clarify that a little bit?
Jeffrey, do you have any more feedback on where you stated that earlier in the presentation? If you do, then go ahead and send that to me, and I'd be happy to have them address that as well. Gina went ahead and followed up on that question that we were asking for a clarification for earlier. Let me go ahead and find her original question. It was stating, how will the seller paid costs be considered? She went ahead and provided an example for that. Hopefully this will clear up the ambiguity in the question. She says the contract states the seller will pay up to $5,000 of borrower's closing costs. She asks if that can pay or go towards their fee or not.
That is an outstanding question, and I don't know the answer of how that would play into it. I would assume that that would have to cover all of the costs, or that would count as the borrower paying. But what I can say is that whatever source you end up getting to pay off the loan has to cover all of the expenses. So if it comes from the borrower, which it sounds like that would qualify for the borrower to me, and again, you guys, I have to apologize. I'm coming from a place that I've been reading this regulation, I've been watching, I've been talking with people, but I'm not a lawyer on this. But from what I see, if it comes from the borrower, all of those costs have to be covered by the borrower, and you can't go outside of that to get compensated in any other way. There can't be any other kickbacks from the loan itself or on the yield spread that goes to compensate the loan officer. So one or the other.
Okay, great. And Laura would like to know, as a broker, do you have to set a compensation standard with a lender as to all loans submitted by their company? To them, will they be lender paid or borrower paid? She states, to elaborate, that as a company, do we have to set a plan as to how we are paid on all of our loans, or can we submit to lender A as quote-unquote lender paid and to lender B as quote-unquote borrower paid? Is that clear?
I think so. I believe that you can negotiate different deals with different wholesale lines, if that's what you're talking about, and that most wholesale lines are going to offer sometimes up to 3 different options. And so one on the lender paid side and one on the borrower paid side. And the borrower paid side would look more like the raw rate without any points built in, and the other one would be based on your compensation, even to the point to where if you said you wanted 2 points on every loan, they would build that into your rate sheet. I hope that's helpful.
Okay. And Cindy would like to know if the best scenario would be to pay a percentage of the loan amount, such as 1%, no matter what the loan amount is, I guess just to be on the safe side?
That's totally up to you. What you should keep in mind is that all expenses have to be covered. So your front end and your back end expenses have to be covered by whatever you're charging in your loan setup. So if you choose to pay that 1% origination fee to your loan officers, that seems like it's shooting straight. And as long as you're not charging the borrower or you're charging the borrower your set points, you have that built into your loan, that sounds like it would work out great. Keep it simple, keep it clean. That sounds like a great idea.
Okay, great. And Nancy states that their loan officers are paid a flat salary no matter what their volume is. And she says, would this be an issue after April 1st?
No. In fact, that's, you have your really crazy good loan officers who have done a lot of volume and who have really made a killing by increasing that yield spread and collecting on overages. That kind of world may be changing, and a lot of people are afraid, in fact, that salaries are going to just lower the compensation of typical loan officers. But in that case, if a loan officer is just getting paid a salary, that seems like a nice, clean way to compensate your loan officers.
Great, great. And Joseph would like to know if you have heard that brokers can get different compensation from several lenders. For example, Wells Fargo rates to you are competitive and you make 1 point, but Bank of America is less competitive and you make 2 points, et cetera, et cetera. So he wants to know if this is how you understand this to work, and if so, how does the broker not have a conflict to sell higher rates?
My understanding is that you can negotiate that with each wholesale line, or that they'll just give you their flat rate on yield spread, borrower paid or lender paid. That you'll have those two options. The anti-steering rules, though, are going to say that you're going to have to give 3 loan options to your borrower, and they are going to clearly see what the conditions of each one of those options are, and it must include, I think, your best rate on those 3.
Okay, great. And Miguel just wants to know if there's any chance that the bill will be overturned or amended at all. Do you have any idea?
From what I see, the answer is no. I hope that there are some minor amendments made to it, but right now everything that we see seems to be moving forward just fine, and the chances of it getting just overturned or delayed, most of the specialists that I've talked to or that I've read say they don't think so.
Okay. Great. And Debbie would like to know regarding the overtime rate that you were discussing earlier. She says that we are thinking we can still pay our loan originators a commission basis with the necessary changes in how they can be compensated, and as well keeping track of their hours. But she says if they go over 40 hours, then we will pay the overtime rate, but how do you recommend we compute the overtime rate?
That's a good question. Are you talking like time and a half? Is that what she's asking?
This is just what she provided. I'm not quite sure.
If she can clarify that, that would be helpful.
Sure.
I'm not quite sure.
Yeah, definitely. Debbie, if you have any more insight to that, or if you can provide an example, that would be great. So here Francis states that we are not brokers and we originate, process, close, and fund our own loans, then sell them on the secondary market. He said we do not collect YSPs, we collect SRPs. And he said, do you think that this will apply to us because they work for a federally chartered bank?
So is he specifically clarifying that they have their own product, and he's saying that they can set their own rates? Does it apply to them? Is that what he's asking? And so maybe
yes,
I'll just go, okay. So based on this, we're talking about 2 different things. So a bank can still set the rates however they want. I mean, if they are going to set a rate to be competitive with the market, that's not the issue. The issue in this new regulation is on the loan officer compensation. So a loan officer at a particular bank may or may not have the most competitive rates. If it's your product, you can charge what you want for it. The challenge is that your loan officers want to be competitive in the market, and they can't be compensated on the front and the back end. So a broker, for example, has to give their rates based on whether they're being compensated on the front. They can't be front and back, and neither can normal loan officers. So I guess what I think you're asking me is this going to affect, as a mortgage bank, what you set your rates at? I don't think so. But if you're asking me if you give your loan officers different pricing and they upsell that and they know what that pricing is and then they get compensated based on that difference along with other compensation, then that's what's prohibited. But a bank can still charge the rate that they charge. It's a product. I hope that helps.
Okay, great. And Debbie went ahead and followed up and clarified. She did state that she was actually asking in regards to the time and a half rate for overtime hours.
Yeah, normal labor laws would apply in that situation. If you're paying somebody on an hourly rate, you have to compensate them based on the labor laws. So that probably isn't regulated specifically by this regulation. It would just be the compensation based on production and based on the yield spread and things like that on the loan.
Okay, great. And Greg would like to know, as an originator for a correspondent lender that also happens to be a bank depository, he says if his bank is willing to pay a flat 75 BP on every transaction, can he have the flexibility of charging origination for his bank to help the bank be more profitable than it otherwise may be? Or is that something that's not okay?
Okay, so he's saying that he gets paid a flat 75 bips, and that's all he gets paid on, and he's asking if he can charge origination on the loan.
Yeah, he's asking if he can.
One.
Yes, he's getting paid the flat 75 BPs, but he just wants to know if he can be flexible of charging origination for his bank to help the bank be more profitable, or if that's a no-go.
My understanding is that the comp is really there to discourage building in a lot of profitability into these loans that is in the on the negative side to the consumer. But my understanding is, you know, the banks still want all of these loans to be profitable, so they still want to see, you know, healthy margins on these products. So as long as you're not getting paid on the front end and the back end, and as long as you're asking the borrower to pay it one way or the other, then yes. And I know that it's some banks' intention to find a way to pay you for the true profitability of the loan despite what the regulation is pushing people toward. I have to say that my gut instinct is that people are going to find loopholes to reward those people who bring in more profitable loans one way or the other. So
okay,
can we
great.
do
Yeah.
maybe one more question, Crystal?
Sure, no problem. All right, Rose states she would like clarification on the following scenario. She says that she works for a bank, the fees from the loan closing are paid to the bank, and the bank works like a broker. The bank then pays the loan officer a set percentage on every loan of the 1% origination fee and the YSP that was paid. She asks, can the bank retain the YSP, just not the loan officer?
So her question is, there's the yield spread. Can they retain the back end? And did she say that she was a mortgage banker or she was a broker?
She says she works for a bank, and the fees from the loan closing are paid to the bank, but the bank works like a broker. So she was wondering if the YSP can be retained by the bank, just not by the loan officer. I'm guessing that she's a loan officer. Hopefully I'm correct.
Okay, I'm not totally sure on the scenario, but I think this may be what she's asking. If it's a bank and they're charging a product that they will sell down the road, but they're funding it, they can fund it at whatever rate they want. And, you know, any of the big banks, they're not telling you what their actual margins are on that product. So that's a non-issue, like she said, as long as that loan officer is only compensated on that origination that she talked about. But they're not telling a bank how to price out their products. They're not telling a bank that it can't still make money on its loans. There is kind of a disadvantage with the brokers that they have to disclose that and banks don't because it's their product. So I think what she's asking is, can a bank price out wherever they want a loan, and then she only is charging origination up and above that? And I think the answer is yes, if I understood the question right.
Okay, great. All right, that was our last question. I know that you all have still some questions here. I tried to get to everyone as much as I could. However, if you would like to contact Larry directly, his His information is still here on your screen, so feel free to contact him. Also, you can contact us. Once again, we are here from CoesterAppraisals.com. I'm going to go ahead and send out our information as well. So if you have any additional questions that you would like answers to, please feel free to contact us. Do not hesitate, and we would be happy to get back to you as soon as possible. Larry, are there any final words you'd like to state to all of our attendees that are still here?
I'd just like to encourage everybody to get out there on the forums, Yahoo Groups, LinkedIn. They're both great places to go to where you can present your scenarios. There are a lot of people just like you who are thinking about those things. If you connect with me on LinkedIn, I'll be happy to direct you to some of the groups that I found most helpful. Otherwise, I've sure enjoyed my time with you, and feel free to contact me either by email or by phone. Sure appreciate it. Thanks, Crystal.
No problem. Thank you so much, Larry, for joining us. And once again, this has been recorded, so it will be available at our website, www.coester.appraisals.com within the next 48 hours. Thank you so much, everyone, for attending, and we look forward to hearing from you soon. Have a great day.